Yeah, so we can now start. So yesterday we had started looking at what we refer to as borrowing cost. And I think I'd already introduced borrowing cost. I'd already introduced borrowing cost. We were supposed to look at an illustration today. We were supposed to look at an illustration today. And that is what I want us we try and actually focus on. That is what I want us we try and actually focus on. That is what I want us to try and actually focus on. And we're going to start with this question. I've already shared it there on the group. I've already shared it there on the group. So it is a question from September. It is a question from September 2021. Question number 4A. So be opening that question. September 2021. Question number 4A. So let me find mine. Yes, September 2021, question number 4A. So are you there? Confirm whether you are there. September 2021, question number 4A. Are you there? Are you already there? September 2021, question number 4A. I've shared the paper on your WhatsApp group. So just confirm whether you have it so that we can start. I can see Steven says yes. What about the rest? Zioka, Godfrey, Geoffrey. Can see Barnabas, yes. I can see Faith, yes. I can see you people saying yes, yes. It is Darubini Limited has provided the following schedule of its long-term loans for the year ended 31st of December 2020. We have a 10% loan note. This one was acquired on 1st of January 2020. So it has an interest rate of 10%. So it is going to last up to the year 2025. We have another one, 12% bond, which will last up to 2028. It means it is an 8-year bond. It is of an amount of 200,000 or 200 million actually. We have another one. They have sold the debentures, and these ones are for a period of 4 years, 60 million. Then you are told additional information about these loans. The 10% loan note and the 12% bond were used to finance the construction of a power plant, which commenced on 1st of January 2020. Expenditure for the construction was drawn, with 100 million being drawn on 1st of January 2020 and 75 million on 1st of July 2020. So the first amount of 100 million was drawn on 1st of January immediately. Then the 75 million was actually drawn on 1st of July 2020. Then the other loan, which is a 6% debenture, was used to finance the construction of a new storage facility. The construction commenced on 1st of January 2020, but no construction took place between 1st of March 2020 to 31st of May 2020 due to COVID-19 restrictions. The facility was available for use on 31st of December 2020, having incurred a construction cost of 60 million. So there was a period of active construction. There was also a period of inactiveness that occurred under the second project, which was the construction of the new storage facility. So if you look at number one, the first facility they're having to construct, a power plant, this one was actually financed by two loans. We have the 10% loan note and the 12% bond. And we said if it happens, a project or a qualifying asset is financed by two loans, we have to compute what? If it happens, a project or a qualifying asset is constructed or is actually derived out of two loans, what do we do? What do we do? What are we supposed to calculate? If it happens, a project is having to be financed by two loans. We calculate what we call the capitalization interest rate. We calculate the capitalization interest rate. So they want the borrowing cost to be capitalized. So that is the first thing you're having to start with. So we say borrowing costs to be capitalized. Borrowing cost to be capitalized. So we do have two projects here. The first project is actually what? The power plant. So you have the power plant. We have the power plant. We have the power plant. So under the power plant, it is actually financed. It is financed by 2 loans. It is actually financed by 2 loans, which have different what? Interest rates. 10% loan note and the 12% bond. So they have different what? Interest rates. So if that is the case, we said you should be able to calculate what we call what? The capitalization interest rate before we can calculate the borrowing cost to be capitalized. So the capitalization interest rate, we have to come up with the capitalization interest rate, which is say you have to take what? The aggregate interest, the aggregate, you take the aggregate interest, aggregate interest divided by the aggregate amount borrowed, divided by the aggregate amount borrowed. Divided by the aggregate amount borrowed, then you multiply by 100%. Multiply by 100%. So it means we'll have to compute the interest. So we have the 10% loan. We'll take 10% of 300, so it will likely be equal to 10% multiplied by 300,000. Because our figures are in thousands. You can actually be able to indicate our figures are actually in shillings of thousands. Our figures are in shillings of thousands. Then we add on. To aggregate simply means to add. We take the 12% on the bond times 200,000. Then divide by the aggregate amount borrowed, which will be 300,000 plus 200,000 plus 200,000. Then you multiply by 100%. You multiply by 100%. So what are you getting as the percentage? Do the calculation. What are you getting as the percentage when you do the calculation? You can round off to 1 decimal place. Just round off to 1 decimal place. What are you getting as the capitalization interest rate? What are you getting as the capitalization interest rate? What are you getting as the capitalization interest rate? I can see 10.8. So 10.8 seems to be the dominant. So we'll take 10.8. 10.8%. So you get 10.8%. 10.8% is the rate you'll be able to use to calculate the borrowing cost to be capitalized. So once you get the capitalization interest rate, there's something you've been told about this project, the power plant. You are told expenditure for the construction was drawn with 100,000 million being drawn on 1st of January immediately. They actually utilized what? 100 million out of this money to be able to do what? Construct. To be able to construct what? The power plant. To construct the power plant. And therefore it means, therefore, the borrowing cost will be, the borrowing cost actually will be, you will take the amount that they actually ended up having to spend immediately. So this one that they actually spend immediately on 1st of January. So 1st of January, on 1st of January, 2020, immediately they actually spent how much? 75 million, 100 million. It was 100 million. So you'll take 10.8% times the 100 million. So that we know the borrowing cost that was actually incurred on this amount spent on this project of what? The power plant immediately. And of course, you haven't been told the ending periods. It means we actually assume this project was actually there for the entire year. It was there for the entire year. It was there for the entire year. So maybe they actually went up to the next year. But our interest is actually what? End of year, 31st of December 2020. We're not concerned with 2021. Now that they haven't told us the ending period, so we assume that this amount that was actually put in as 100 million was actually utilized for the entire year. And therefore, we'll have how much there? 10,800, Sindio? 10,800. Then on 1st of July, they actually put in how much? 75 million. So you have 1st of July, 2020, they actually put in 75 million. So it will be 10.8% times 75 million. But this one now was for 6 months, so times 6 out of 12. So what do you get? When you multiply by, because it was for 6 months, you see, from 1st of July up to the end of the year, those are how many months? Ni miezi sita. So it means this amount here was actually only incurred from what? We actually account for borrowing costs from the debt the amount is actually spent. We account for the borrowing cost from the debt the amount is actually done what? Spent. From the debt of what? Expenditure. From the debt of expenditure. And therefore, we'll be able to take 10.8% times 75,000 times 6 out of 12. You're getting 40, 50. You'll get 40, 50. And therefore, you'll be able to get the total borrowing cost on this power plant. The total borrowing cost that was actually incurred on this power plant. You'll get an amount of 14,850. 14,850. 14,850,000. 14,850,000. So that will likely be the borrowing cost on what? The power plant. The borrowing cost on the power plant. So then we have what? Additional information number 2. So that is another item or qualifying asset that they are having to come up with. It is known as what? A storage facility. It is known as a storage facility. And therefore, we can be able to come up with what? The borrowing cost on the storage facility. This one is for the power plant we've already completed. Now we can be able to look at the storage facility. That was for the power plant. Now we can look at the storage facility. Let's look at the storage facility. That was for the power plant. Now we have another item which we are calling what? The storage facility. The storage facility. We have another item which we are calling what? The storage facility. So the 6% debenture was used to finance the construction of a new storage facility. The construction commenced immediately on 1st of January 2020. So from 1st of January, the construction took place from 1st of January 2020. So it went up to which period? It actually went up to which period? It went up to end of what? End of February. So it went up to February. So you can be able to say maybe 28th of February. But there was what? A period of inactiveness. There was a period of inactiveness there of March. So you have March, April, and May. Those are how many months? 3 months. There was a period of inactiveness of 3 months. There was a period of inactiveness of 3 months. Then they actually commenced again the project after the COVID-19. They actually commenced again the project when? On 1st of June. So 1st of June, they commenced. Then they actually went on up to 31st of December. 31st of December. 31st of December. So overall, it means the period of active construction was how many months? Overall, it means the period of active construction was how many months? The period of active construction in totality, it was how many months? According to what you've just said here, the period of active construction was how many months? It was 9 months. 9 months is correct. So it means when you're having to compute the borrowing cost, we'll only capitalize the borrowing cost during the period of active construction, which is actually what? 9 months. And therefore it means the borrowing cost here will actually be the borrowing cost here. You'll take, you see this one, they are using what? The 6% debenture. So you'll take 6%. 6% times what? They incurred 60 million to construct, times the 60 million. But now you only consider what? 9 out of 12. You don't consider the entire period. So what are you getting as the borrowing cost? What are you getting as the value of the borrowing cost when you do that computation? So 6% times the 60 million they put into that project, and that is the amount they borrowed under the debenture. You'll get how much? 6% times 60,000 multiplied by 9 out of 12. You get 2,700 or 2.7 million. 2,700 or 2.7 million. Remember, our figures are in thousands. So you'll actually get 2.7 million. 2.7 million. So that is what you are required to compute under number 1. Borrowing cost to be capitalized for each of the projects. So for the power plant, you'll capitalize 14,850,000. For the storage facility, you'll capitalize 2.7 million. 2.7 million. Then the second part of the question is calling upon us to indicate the value of the assets to be accounted for in the books of accounts of Darubini by the end of 31st of December 2020. So we said, if you're having to account for these assets, we'll be able to consider what? The borrowing cost. We'll likely be able to consider the borrowing cost. If you are accounting for these assets by the end of the year, we'll have to accumulate their total costs, their value of the assets, together with what? The borrowing cost. And we do have two items here. We have the power plant and we have the storage facility. So we have the power plant and you have what? The storage facility. The storage facility. So the amount that was actually incurred, so cost incurred, the cost incurred on this power plant, there were two amounts that were actually incurred. We have 100,000 plus 75,000. So the cost incurred for this year 2020, it was 100,000 plus 75,000, which comes to an amount of 175,000. Then the amount incurred on the storage facility up to the end of the year, this one is just very direct. It was actually 60 million or 60,000 if you reduce the zeros. But now we have to add on the borrowing cost. Add borrowing costs. Because the borrowing cost we are called, or we actually advised, you're supposed to capitalize them. The borrowing cost, you're supposed to be able to do what? Capitalize them. And therefore, you will take what you've been able to calculate as the borrowing cost, you add on this, so that you can be able to get the total value of the asset to be accounted for by 31st of December. So this one was actually coming to 14,850,000. And this one was coming to 2.7 million. And therefore it means the value of the asset, value of the asset, value of the asset, value of the asset, it will be 189,850. 189,850, then 62.7. 62.7. So that will be the value of the asset to be accounted for in the books of accounts or financial statements of Darubini by the end of the year. This is what we mean by having to capitalize the borrowing cost. So this value of the asset, you'll add on the borrowing cost. You'll take to the statement of financial position this figure, not this one alone, this one. We'll take that one to the statement of financial position. So that's how you could have actually been able to deal with that one. So we can be able to look at another one, December 2022, question number 3B. Open December 2022, question number 3B. December 2022, question number 3B. December 2022, question number 3B. If you are there, you say yes, we are there. If you are there, you say yes, we are there. So I can see you are saying yes, you're already there. So December 2022, question number 3B. So December 2022, question number 3B. December 2022, question number 3B. So the question reads like this. So you are told, Sayari Limited obtained a 10% loan note amounting to 24 million on 1st of January 2021 to finance the construction of a new factory. As the funds were not all required immediately, Sayari Limited invested 10 million in a 6% bond until 31st of May 2021. Construction of the factory began on 1st of March 2021. However, due to unexpected shortage of skilled labor, the project ceased during the month of July and August 2021. By 31st of December 2021, the project was not yet complete. It was still going on. Explain with suitable calculations the accounting treatment of interest on cost on the loan note in the financial statements of Sayari Limited as of 31st of December 2021 in accordance with our International Accounting Standard number 23, which we refer to as borrowing cost, which we refer to as borrowing cost, which we refer to as borrowing cost, which we refer to as what? As borrowing cost. So we can be able to use a table to be able to present this, to just be able to know the accounting treatment of interest on cost on the loan note. So you must actually be able to determine what the borrowing cost that was actually incurred on this amount that was actually put in this particular project or construction of the new factory. So you can say borrowing cost on construction of new factory. Borrowing cost on construction of what? Of new factory. Borrowing cost on construction of the new factory. So you can actually be able to present a table. So you can say shillings. You can use shillings of thousands. Let's use shillings of thousands. Shillings of thousands. So generally, if you are looking at everything, so without having to consider activeness or inactiveness, we have an interest of what? 10%. Is it 6% or 10%? So it's interest of 10%. So interest, so total interest on the borrowed amount. So the total interest on borrowed amount. Total interest on borrowed amount, you will take that 10%. It will be 10% times 24 million. It will be 10% times the 24 million. It will be 10% times the 24 million. So you'll have shillings, thousands. So it comes to how much? 2,400 or 2.4 million. 2.4 million. So that is like the total interest, if you don't actually consider what? The inactiveness periods. So that means once you have this total interest, we said the interest that was actually incurred, during the inactive period of construction of a qualifying asset, you don't consider it as part of the cost of what? You don't actually consider it as part of what? The cost of the borrowing what? Cost. Also interest incurred during the pre-construction. So the interest incurred during what? The pre-construction period, you also don't do what? Consider it as part of what? The borrowing cost. You have to eliminate it. You have to remove it. You don't actually consider it. So the pre-construction period was how long? The pre-construction period was how long? It was how many months? The pre-construction period. Look at the question. The pre-construction period was how many months? It was 2 months, because you can see you are being told the project commenced on when? On 1st of March. So we have to eliminate that interest, because this one is for the entire year. We have to eliminate that interest for what? For pre-construction period. So interest, pre-construction period. The interest pre-construction period, it will likely be 10% times 24,000 times 2 out of 12. So how much are you getting when you do that calculation? How much are you getting? 10% times 24,000 times 2 out of 12. We consider for 2 months. How much are you getting? you get 400. So we'll eliminate this one. This one you said you don't capitalize, but it'll likely be recognized as an expense in the income statement. It will be part of what you'll be able to recognize as an expense income statement. You don't capitalize. You'll likely be able to recognize it as an expense in the income statement. Then also you do what? Consider interest during the inactive period of construction. Interest in active construction period. In active construction period, interest in active construction period. How many months were inactive? How many months were inactive? Also 2. There were 2 also, Sindio. Because you are told which months did they not actually construct due to COVID-19. However, due to an expected shortage of skilled labor, the project ceased during the month of what? July is not COVID-19, but July and of course what? August. Still 2 months. Huh? So you'll say what? 10% times 24,000 times 2 out of 12. You also have to eliminate that interest. Huh? So this one still will be able to go as what? An expense in the income statement. You won't actually end up having to capitalize it. You won't actually end up having to do what? Capitalize it. You won't actually end up having to capitalize it. So once you have this, there's something else you must actually be able to consider in your computation of the borrowing costs. Who can be able to tell us what should we also be able to consider in our computation of the borrowing cost? What should we also be able to consider? What should we also be able to consider in our computation of the borrowing cost? The interest income. Very correct. This is very correct. The interest what? Income. The interest income. So we'll consider what? The interest income. Remember, these ones are expense. Interest income. You must read the notes we wrote yesterday. The interest income. The interest income, you will only consider the interest income during the active period. And therefore, you'll say interest income active period. The interest during the active period. The interest income is actually 6%. So how much was actually invested out of this amount borrowed? It was 10 million. So Sayari Limited invested 10 million. So you'll say 6% times the 10 million times how many months? You'll say 6% times the 10 million times how many months? So you'll say 6%. I can see 6, I can see 5. So which is which? I can see 6, I can see 5. So which is which? I can see 6, I can see 5. So you see, you have to be very careful. You see what you are being told? You are being told, as the funds were not all required immediately, Sayari Limited invested 10 million in 6% bonds until 31st of May 2021. So those are how many months? 5. Of course, they are 5. But what are we saying? Interest income earned during active. Does it tell you something? So it will be how many months? Interest income earned during what? Active. During active. They invested the money, of course, for 5 months. But we must only be able to consider interest income earned during the active period of construction. So it will likely be how many months? 3. It will be 3 because the project commenced on 1st of March 2021. So this money was invested, of course, from January for 5 months. So March, it can earn interest. April, it can earn interest na May. Lilfika May, that bond had actually come to an end. That bond had actually come to an end. So we won't consider the pre-construction interest income earned. That one, you'll be able to consider it as what? As an income. You'll likely consider it as what? As an income in your income statement. So only what you'll be able to consider is the interest income earned during the active period of what? Of construction. So don't say 5 months because the 2 months were what? Pre-construction. The 2 months were pre-construction. Take note of this term, active. And I was really repeating it yesterday. Inactive, active. Inactive, active. It has a meaning. You have to be very keen. It is not 5 months. It is 3 months because you have what? March, April, and May. The project commenced in March. The interest income earned January and February, it is irrelevant for us in having to account for what? The borrowing cost. It was a period of what? Of inactiveness. That interest income earned, you won't actually be able to consider it when you're having to calculate what? The borrowing cost. What you'll only be able to consider is the interest income earned during the active period of what? Construction. And there will likely be 3 out of 12. 3 out of what? 12. 3 out of 12, like that. 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 3 out of 12. How much are you getting? How much are you getting? I think there's something I messed up with here, so it will actually jumble up. It will jumble up what I wanted to be achieved here. It will jumble up what I wanted to be achieved here because you're supposed to deduct it from this one. So I don't know whether you can be able to create another column. I don't know how you've written in your book. You can remove this amount here. Remove this amount here. Remove this amount here. Then you can be able to say here, 2 columns, shillings, thousands. It will jumble up what you've written there in the book. So this amount you had calculated here of 2,400, you can be able to put it here. 2,400, you can be able to put it in this column. Then this one, before you can be able to add, you can be able to add, just leave, don't put the negatives, Don't put the negatives. Don't put the negatives, just leave it like that. Don't put the negatives, just leave it like that. Then now, what do you get when you calculate this one? You're getting 150. You're getting 150. So it will likely be 150. You're getting 150. It seems a very small figure. It is 150. It is 150. So we said what will happen is that you'll have to deduct this interest income earned from what? The borrowing cost. Of course, the borrowing cost you're having to see, they're actually these two. They're actually those two. It is actually okay. Can be able to see this is the total borrowing cost is actually 2,400. So this one will likely come to 800. So you'll likely be able to say here 800, which is okay. Then now you'll be able to deduct. You'll likely be able to deduct 150 here. So it is okay. 150. In fact, I should have just left the way it was. So there's no problem. I should have just left the way it was. So you'll likely be able to deduct this 800 as the borrowing cost. As the borrowing cost during what? The inactive period. Then also you end up having to do what? Deduct the interest income earned. So with that total, then now in this case, you'll be able to get what? The total borrowing cost incurred. Total borrowing costs incurred. Total borrowing cost incurred. How much are you getting? So how much are you having to get? How much are you having to get when you deduct? So you can still just leave it the way it was. I had not actually seen. If you just leave it the way it was here, should have actually been correct. So you luckily have 2,400 as the total borrowing cost. Deduct the borrowing cost during the inactive period, then deduct interest income earned during the active period. You're getting 1,450. You're getting 1,450. So 1,450 will likely be the correct figure for the borrowing cost. So like that. So that is what the total borrowing cost that was actually incurred on the construction of what? The new factory. The new factory plant. So always consider only interest income incurred or interest income that was actually realized during what? The active period, to be able to do what? Deduct from the borrowing cost. Then if you are talking about the borrowing cost or the interest on the borrowing cost, you'll only be able to consider the interest that was actually there during the active period. So we must actually be able to eliminate that interest incurred during the period of what? Inactiveness and also what? Pre-construction. These ones are not actually part and parcel of what? The borrowing cost. You will eliminate them from the total what? Borrowing cost. You never consider them. You won't actually end up having to do what? Consider them. The other way you could have actually been able to do it is you eliminate these 2 months. This one and this one. So you'll actually only be able to say 10% times this times 8 out of 12. That is another way you can be able to do it. But just now to be able to clearly show it, be able to clearly show it and at least be able to get the 8 marks, you'd rather go with this particular kind of an approach. So you have the total interest up to the end of the year 2.4. You eliminate the pre-construction interest, which is 400. You also eliminate the inactive period interest, which is actually 400. So you get a total of 800. Then you also eliminate the interest income that was actually earned. So this one reduces the borrowing cost, because now it is like having to set off part of what the cost you're having to incur on that amount you've borrowed to construct what the factory plant. And therefore the total borrowing cost incurred will likely be 1450. It will likely be 1450. So that's how you could have actually been able to get that one. You could have actually been able to get that one. Then of course, as you've already been able to indicate, you can actually be able to indicate, or you can be able to write. Because they wanted you to do what? Explain with the suitable calculations the accounting treatment of interest on cost on the loan, not in the financial statement of Sayari Limited. So you can be able to write this after that, write these points after that, just to be able to explain. You write the interest during the pre-construction period. This one now, the interest during the pre-construction period, you write a point after that. You can put an asterisk or a dash. The interest during the pre-construction period will be accounted for. The interest during the pre-construction period will be accounted for as an interest expense. The interest during the pre-construction period will be accounted for as an interest expense. Then also you write the interest during the inactive period of construction. The interest during the inactive period of construction, this one now. The interest during the inactive period of construction will be accounted for as an expense in the income statement. Will be accounted for as an expense in the income statement. The interest incurred during the inactive period of construction will be accounted for as an expense in the income statement. Will be accounted for as an expense in the income statement. Will be accounted for as an expense in the income statement. Then the last statement, the interest income realized during the active period, the interest income realized during the active period, the interest income realized during the active period of construction will be deducted from the borrowing costs. The interest income realized during the active period of construction will be deducted from the borrowing cost. Then you write the final statement now. The total borrowing cost will be capitalized. The total borrowing cost will be capitalized as part of the cost of the new factory. The total borrowing cost will be capitalized as part of the cost of the new factory. The total borrowing cost will be capitalized as part of the total cost of the new factory. In the statement of financial position. In the statement of financial position. So that's how you could have actually been able to account for that one. And that's how you actually account for borrowing cost. So I want us to do another question. on borrowing cost. But before that, we can be able to have a small break of like 5 minutes. Let's have a break of like 5 minutes. Then we come back. I want us to look at another question, which I'm going to share immediately on the group there. You're going to see it. Is another question on borrowing costs. Yes, welcome back. So can we continue now? So I think the break is quite enough. The break is enough, so we can proceed. We can proceed. The break is enough. We can proceed. Can see you are saying yes. So I've shared that question. It is borrowed from 2012, question number 5D. So just confirm whether you have the question. You've already been able to see it. Just confirm whether you have the question. You've already been able to see it. I've taken a photo. You should be able to see it. I've taken a photo. I've taken a photo. I've taken a photo of it. I've taken a photo of it. A photo of it. So it is actually December 2012, question number 5D. December 2012, question number 5D. It is almost a similar question that was actually tested. There's a sitting in 2024. Can't remember the exact sitting. A very recent sitting. They tested almost a similar. I think it could be almost exactly the same. It could be almost exactly the same. They tested such kind of a question. So the question reads like this. Assure Limited borrowed 30 million to finance two capital projects, A and B, on 1st of July 2011. The money was utilized on the two projects as follows. So on 1st of July 2011, they actually spent 5 million. And then on 1st of January 2012, they spent also another 5 million on project A. Then on project B, immediately they actually spent how much? 10 million. Then the other amount of 10 million was actually spent after like 6 months on 1st of January 2012. In totality, if you look at that amount, comes to what? 30 million. Because in project A, they put in 10 million. In project B, they actually put in how much? 20 million. Then the unutilized funds on 1st of July were invested temporarily at the rate of 7% per annum. The rate of interest on the loan was actually 9%. The rate of interest on the loan was actually 9%. So the borrowing cost in terms of interest was actually having to be charged at 9%. Then you are called upon to determine the borrowing cost to be capitalized for each of the projects as at 30th of June 2012 and the value of the assets in the books of Assure Limited, as at 30th of June 2012. As at 30th of June 2012. So the first one, you are supposed to come up with what the borrowing cost to be capitalized. So the first one, you are supposed to come up with the borrowing cost to be capitalized. Borrowing cost to be capitalized. You're supposed to come up with the borrowing cost to be capitalized. We have two projects. We have project A and you have project B. So of course, we are going to present our figures in, let's present our figures in what? Let's just let them remain the way they are in shillings of what? 1,000. Let them just be as per the question. Let's just present them the way they are. Let just them be as the way they are in the question. So on 1st of July, so immediately on 1st of July 2011, on 1st of July 2011 for project A, they actually put in immediately how much? 5 million. They actually put in immediately how much? 5 million. 5 million. And therefore, we can be able to calculate the borrowing cost on that 5 million immediately, what they actually put in. It will be 5 million multiplied by the interest rate that you're having to be given is actually how much? 9%. So times 9%, times 9%. And of course, this one was for the entire year. It was what? For the entire year, because they actually accounted for the interest on this amount they put in immediately. And this project had not actually come to an end by the end of the year. So it means this interest charged on this 5 million put in immediately was up to the end of the year. So it will actually be 12 out of 12. 12 out of 12, like that. Hope you've been able to see what we have done there. Have you seen what we've done there? We are saying immediately the project started, Out of the amount they borrowed, the 10 million, they actually put in how much? 5 million. So it means on this 5 million, they had actually put in immediately, they actually ended up having to incur what? The interest on this amount up to what? Up to the end of the year, because the entire project is going to last how much? The whole year, and they're going to put in totality how much? 10 million. But the 5 million, they're not going to put in immediately. They'll put in immediately after what? 6 months. On 1st of what? January 2012. On 1st of January 2012. Just to be able to understand, maybe you can be able to write an NB just under this table. Write an NB just under this table. Write an NB under this table. Write an NB under this table. You can leave like a space of like maybe 6 lines. 6 lines, because what you'll do here, there'll be almost like 6 lines. Leave like 6 lines, then you write an NB. Write an NB. You write capitalization of borrowing costs. Capitalization of borrowing costs. Capitalization of borrowing costs is based on capitalization of borrowing costs is based on capitalization of borrowing cost is based on actual expenditure. Actual expenditure. Capitalization of borrowing cost is based on actual expenditure. Actual expenditure. And when the money borrowed, capitalization of borrowing cost is based on actual expenditure. And when the money borrowed is actually spent. And when the money borrowed is actually spent. Capitalization of borrowing costs is based on actual expenditure. And when the money borrowed is actually spent. And when the money borrowed is actually spent. Capitalization of borrowing cost is based on actual expenditure. And when the money borrowed is actually spent. And when the money borrowed is actually spent. So the money borrowed was 10 million. And the first 5 million out of the 10 million was actually spent at the start of what? The project. And therefore, this one will incur interest up to the end of the 12th month. And therefore, what are you having to get? What are you having to get when you do the calculation? 9% of that. What are you getting? 9% of the 5 million. You're getting how much? 9% of the 5 million, you're getting how much? Barnabas, 9% of 5 million. How much do you get? 450,000. You'll get 450,000. 450,000. Then on 1st of January 2012, they actually put in what? They actually spent. Capitalization is actually based on what? When the money was actually spent. And the amount that is actually what? Actually spent. So after the 6 months, they actually put in another 5 million. So they actually spent this one. And this one now is only for 6 months. Because it was just from what? 1st of January. 1st of January, it was 1st of January up to end of June. So it was actually how much? How many months? 6 months. So how much are you getting? I think you should be able to get half of this, because this one is 6, this one is 12. So I'm also a mathematician there. It's supposed to give you 225,000. 225,000. So how much are you having to get as the total? When you add, you should be able to get 675. 675,000. You should be able to get 675,000. 675,000. Then there's something you're having to be told in the paragraph there. Unutilized funds on 1st of July 2011 were invested temporarily at the rate of 7%. How much were the unutilized funds? Barnabas, if you are following what you're having to learn, how much were the unutilized funds? How much were the unutilized funds? It was 5 million. Very brilliant. Very brilliant. You are the most brilliant students I've just met this year. Very brilliant there. The unutilized funds were how much? So invested funds or interest and unutilized on unutilized funds. So they were 5 million and they earned interest for how many months? 6 months. So 5 million times 7% times 6 out of 12. How much are you getting as the interest earned? This 5 million, they never invested. This one, you see this one, they put in January. Walikuwa bado tu wana idle nayo. Wakaiweka kwa investment. Ikawapea interest. How much are you having to get? As the interest earned. How much Barnabas? Will-Kister. How much are you getting? 5 million. This one they earned interest. We said wewe ni Mkenya ule wa kawaida. So unapata hiyo pesa kama utumii unaweka kwa investment ingine, it brings in some income. It will be able to reduce what you are borrowing cost. It will reduce your borrowing cost. It was actually 175,000. 175,000. So you actually deduct. So now with this, you'll actually be able to get what? The total borrowing cost, which will come to 500,000. Which is going to come to 500,000. Then we go to project B, just the same. Now, once you've already been able to do project A, it will just be the same. So on 1st of July 2011, they actually put in immediately how much? 10 million. So it means it will actually be 9% times 10 million times 12 out of 12. So this amount spent immediately on project B of 10 million will incur interest for the entire 12 months up to the end of June 2012. And therefore, you'll take 9% times 10 million times 12 out of 12. How much are you getting? 900,000. Is it 900,000? Confirm. Is it 900,000? It is 900,000. 900,000, yes. It will be 900,000. It will be 900,000. Then, also, these ones, this project B, on project B also, they never put in 10 million immediately. They put in 10 million after how many months? 6 months. So it means we'll take 9% times 10 million. Now for the other 10 million, it was only for 6 months. It will be half of that. It will be 450,000. You should be able to get the total borrowing cost here to be 1350,000. But now there's the interest they earned. On this 10 million, they never utilized immediately, which will be 7% times 10 million times 6 out of 12. So how much are you getting as the interest earned? How much are you getting? Nzioka. How much are you getting? Nzioka. How much are you getting as the interest earned on the unutilized funds? These ones, they never utilized immediately. Wali hold kwanza for 6 months, ndio wakaekelea kwa project. But your time, ni Wakenya wa kawaida. Walieka kwa bonds, ikawaletea pesa. So that will be able to set off what? The borrowing cost to be capitalized. It will reduce it. Because you're incurring the borrowing cost, but when mjanja, you want to reduce it, you actually go and actually earn what? Interest, the other side. So 350, as you're saying, 350,000. 350,000. You deduct. And therefore, that will be able to give you a total borrowing cost on this one of an amount of 1 million. An amount of 1 million. 1 million. An amount of what? 1 million or 1 million. An amount of 1 million or 1 million. An amount of 1 million or 1 million. An amount of 1 million or 1 million. And of course, you'd have actually been able to get what? The borrowing cost to be capitalized. You would have been able to get the borrowing cost to be capitalized. The second part of the question, they wanted you to get the value of the asset in the books of Assure Limited as at 30th of June 2012. How easy is that now? How easy is that now? Once you've already gotten the borrowing cost, that one becomes very easy. So let's look at the amount to be accounted for as the value of these assets, Project A and Project B. The amounts to be accounted for as the value of the asset for Project A and Project B. Value of the assets for Project A and Project B. Value of the assets for Project A and Project B. So value of the assets, that is Roman number 2. Value of the assets. value of the assets in the books. So Roman number 2, value of the assets in the books of Ashua. Value of the assets in the books of Ashua. Value of the assets in the books of Ashure. Value of the assets in the books of Ashua. Books of Ashua. So we have project A. Project B. So the cost of these assets, so the expenditure incurred or the cost incurred. So on this one, it is 10 million because you have 5 plus 5. On this one, it is 20 million because you have 10 plus 10. But now we have to do what? Add on what? The borrowing cost. So for this one, we've been able to get how much? The borrowing cost is coming to 500. It's 500,000, yes. And this one is coming to 1 million. So we should be able to add, this one will be 10 million, 500,000. This one will be 21 million. Because that will be the value of the assets. That will be the value of the assets. So we have already been able to complete that one. Will be the value of the asset. This one will be 21. And this other one will likely be 10,500,000. It will be 10,500,000. 10,500,000. 10,500,000. So that's how you could have actually been able to account for those values of the assets and account also what? For the borrowing cost under the two projects. So that is project A and project B. So this one is a bit common in the exam. So borrowing cost is actually a bit common in the exam. And I think I'm going to give an assignment. The one I'm just having to talk about is almost a similar question to this one. It was actually tested in, I think it could be 2024 or early 2025. It could be April or December 2024. But I'll be able to get the question. Then I think I should be able to share. You can have a look at it and see whether you can be able to attempt the way we've been able to do this one here. So for today, I'm going to end there because I have something to be able to attend to. So I'll finish the class a bit early, but we should be able to meet tomorrow. There's that assignment I actually gave. So some of you try to attempt. We'll do it as a special revision tomorrow. As I promised, we're going to be doing special revision classes every Saturday. So you'll likely be doing from 10 up to around 11. So I'll be able to do that particular class from 10 up to 11. Then also be able to have our normal session from 2 p.m. So from 2 p.m., we look at the very, very final parts of topic number 2. That is foreign exchange rates. Then I think we'll be able to look at revenue contracts. Then I think we should be able to finalize on topic number 2. So that's what we'll be covering tomorrow. So tomorrow I'll be able to do the revision for that assignment. And I think if there'll be any other question I could be able to add within the 1 hour, I'll be able to add it just on what we've already been able to cover. Then at 2, we'll be able to meet, then finalize on topic number 2. Because next week I want us now, we start on topic number 3, which is on what? Different entities, accounting for different entities, partnerships, advocates, lawyers, agriculture, cooperative societies. That's what we'll likely be covering under topic number 3. Topic number 3 is a bit detailed. And I think now you should actually start having to gain the momentum because we are now moving to the most commonly tested topics in the exam. So starting from next week, the most commonly tested topics in the exam are the ones you'll likely be looking at. So of course, this topic number 2, borrowing cost, is very common compared to the rest that you've been able to do. Long-term construction contracts rarely tested. Hire purchase rarely tested. This one, commonly tested. Borrowing cost commonly tested, more so in the recent past. More so in the recent past, the examiner has really liked having to test on borrowing costs. So is an area you have to be very keen about. These borrowing costs. Be able to understand it properly. These borrowing costs. Any question you might be having? Kindly ensure all the revisions are recorded. Hey, if you've ever attended my classes, if you've ever attended previously my classes, they are usually religiously recorded. Religiously recorded. Hey. Revision classes are usually religiously recorded. I know the essence of those revision classes. I really value them. I really value them. All of them will be recorded. All of them will be recorded. You'll get them on the LMS. You'll get them on the LMS. Any other question? Any other question you might be having before we end there? So we'll record all of them. So if you just happen to miss, you don't have to worry. So you just get it on the LMS. You just get it on the LMS. So no problem. Maybe in the evening, tomorrow you catch up with it so that you're actually at par. Seems there's no any other question. So let's end there for now. Wishing you a good night. Wishing you a good night.